All right, listen up. Are we at the beginning of the end or the end of the beginning for the multifamily industry? For years now, we've said survive till 25. Well, the new year is past and it is 2025, and the multifamily industry is at an inflection point. Today on the Gray Report, we're going to be talking about what the next 12 months could look like for the multifamily industry, with the treasury yields running even higher, but investor sentiment is also creeping up as investors are bullish on the long-term fundamentals of multifamily. We've got some great reports and new data on the Gray Report today. A piece from RealPage: resounding appetite for apartments overtakes supply fears in the fourth quarter of 2024. But from the Harvard Joint Center for Housing Studies, new projections anticipate a slowdown in household growth and housing demand over the next decade or so. Then from Marcus & Millichap, surging sentiment could favor CRE in 2025. Then Cushman & Wakefield has 10 questions for this year in 2025. From MSCI, investment trends and focus, key themes for 2025, and Moody's Analytics Q4 2024 preliminary trend announcements. This is going to be a big year for Gray Capital, big year for the multifamily industry, and big year for the Gray Report. I want to thank all of our viewers and listeners who have stuck with the Gray Report since our inception in 2020, those who subscribe to the newsletter, which you can do at graycapitalllc.com. Thank you all so much for being here. If you're not subscribed to the Gray Capital YouTube channel, do so now. Like this video and hit the bell icon so you can be notified when every new episode of the Gray Report is released. Got a great episode, a lot to talk about. Let's get into it. Welcome back to the report. Join again, Dr. Matt Bosnagel, Director of Communications and Marketing, and producer of the Gray Report. How you doing, Matt?
Pretty good. Things keep happening every week. I'm glad that they still do.
Earth keeps spinning.
Earth keeps spinning, and maybe
leases keep getting signed.
Yeah. And some things are still interesting, and in that way, I'm still surprised. There's still work to be done.
So one thing that's surprising me, Matt, a little bit is this 10-year Treasury yield. I know right before it's not so specific on the docket, but Treasury yields are rising, and this is not the narrative that folks were talking about several months ago of lower rates in 2025. This idea that we've said for the industry has been saying for years, survive until 2025. We should see inflation really coming down. We should see lower interest rates, and really the market stabilizing. And there have been a lot of signs of the market stabilizing. Inflation is much lower than it was 2 years ago. That's for sure. But there's some more uncertainty. There's more speculation. We've got a new presidential administration coming in, and that is fueling the fire of maybe some more inflation. Maybe the Fed missed the boat a little bit. And they just got ahead of. They didn't miss. They just got ahead of themselves a little bit in terms of rate cuts. The economy was still going so strong. There wasn't the evidence that they had put enough pressure on the economy to slow inflation down permanently. Because ADP came out with a jobs report this morning. Unemployment is still going down. There's not very many firings that are going on, not many folks that are looking for unemployment insurance. We're going to get the full jobs report out this Friday. In some cases, it looks like the economy is going to be in a great shape in terms of wage growth, economic growth, the tax cut, when the tax bill gets redone this year, lower taxes, that should be an economic driver. But, too much growth can and does lead to inflation. And so is it going to be stable growth and sustainable growth? Yeah,
that's what I wonder. Is this is it a product of just the increased economic activity? That's something that is actually borne out in all of the reports that we covered. Every time they hit on the economy, they're talking about, and interest rates are higher than we expected that they would be. So this is something that we weren't expecting a year ago, but it's kind of been building a little bit. And I think also, I'm a little worried about labor market softness in certain areas. I guess the quits rate is a little lower, which is fine. It just means that people want to, they're hanging on their jobs a little longer. There's a slight amount of uncertainty in the labor market, but I think that compared to other countries too, and we'll see this in the MSCI report, the U.S. economy did pretty great last year. Even the stock market, which had a little bit of tumble in December.
We're really complaining that the economy didn't really just slow down to a screeching halt, and that unemployment didn't go up. That's what's fueling a little bit higher growth and a little bit stickier inflation. And so, in one level, that's really not a horrible thing at all. Where it becomes a challenge and a problem as we see continued inflation that's persistent, and does that become sticky because psychologically folks are now returning that narrative of that we are going to see some longer run inflation. It hasn't gone away.
Yeah, because
or how much is this just speculation on tariffs and the whole Trump thing?
I don't know. We can talk about that.
A lot of that's
Put a pin in that,
too.
please.
Yeah.
Well, because I think a lot of times when you hike up interest rates, you think that you bring it has a deadening effect maybe on hiring, on the labor market, and on the economy in general. And we hiked up interest rates, and the economy has been humming along, which almost makes you think like, wow, in the absence of that, would inflation have persisted?
Yeah, I mean, to me. And to others, what it seems like is, the goal of raising interest rates, the Fed funds rate, was to really slow down inflation, kill inflation, slow down the housing market, slow down hiring, prevent a wage price spiral, really just to throw cold water on the economy. And it's like the fire was burning so hot that like we threw water on it, but it just like evaporated all the water and kept burning.
Yeah.
And we're like, well, we've thrown enough water on it. And at the same time, all the folks in the capital markets world, in real estate, anyone that uses, debt and leverage really throughout the economy, just basically just been complaining that like interest rates are high. We can't do all the transactions we want to do. We can't do the deals we want to do. And the Fed's like, well, the economy is doing kind of fine. We're like, yeah, but interest rates are too damn high. And there's arguments like, well, they're kind of just normal, historically. But it's different than it was the last cycle. We want lower interest rates, and the Fed's like, fine, okay, yeah, we've kept the rates high, and for too long, fine, we'll start this path of decreasing interest rates, because by now we should have seen enough effect, and we've seen a little bit of slowing. But again, looking around, anyone paying attention is like, the economy isn't doing that bad right now. It's not like we're seeing these signs, like the cracks aren't that deep. Everyone was looking for the hyper focus on looking for the cracks, looking for the slowdown. And in retrospect, it's like, did we really see enough of it to justify reducing interest rates?
I wonder.
I was definitely in favor of it. But
oh, for sure, I was, and I was too, and I still think that I still think that the calls for the Federal Reserve to raise interest rates or to keep them that much higher, I think that the economy can weather a few more interest rate cuts. I don't think that inflation is convincingly increasing. So there's lots of reasons, I think, to continue to lower interest rates, but that's not what the people that are buying 10-year treasuries are thinking.
Well, and especially, we were talking about this before we started the show. A lot of this, I believe, has to do with the new Trump administration, and some of it's real, some of it's really just over speculation. And you and I were talking about how shocked we are that some people still fall for the bait in terms of, hey, he's coming out saying he's going to do 20% tariffs, 30% tariffs on China. We know that that's not going to happen. We know that it's a negotiating tactic. They're going to deport, millions of people. Well, I mean, maybe we'll get back to the deportation levels that we saw under Barack Obama, but I don't think it's going to be nearly as meaningful. It's so much of it is rhetoric. But people are factoring it in like absolute truth. These things are going to happen, not like they're negotiating tactics. And at most, you discount them by 50%. And the people in the institutional elite media are certainly following for it. And there are clearly folks, whether it's in foreign investors, sovereign wealth funds, big institutional, they're clearly falling for it too. And they're saying, well, if they actually does what he says he's going to do, then this will happen. And so you're falling for it hook, line, and sinker. Do you really think that all that will happen to the extent that is being described? Do you think that we're going to invade and take over Greenland and Panama? And it's hard to adapt to a world of trying to filter through someone who says things that are being put out there for deflection, and it's strategic, and a lot of it does seem like ridiculous, but when you see it through like a strategic lens, it starts making somewhat more sense. But you look at the people who are taking it at absolute face value and are making $1 trillion decisions in terms of treasury markets and money flows. You really just have to scratch your head. But it also exemplifies how ridiculous some of the folks in those positions in the economy, leadership,
Yeah,
are.
I think that Trump's method of communication is to foreground like the dramatic things, and like he's not going to say we have a lot of these plans. It's a lot of nuance, little tweaks here. No, he's going to say universal 20% tariffs.
Yeah.
And there are things that make an impact. And
All
then,
he wants to do is he wants to go get a deal.
Yeah,
like that's
yeah,
all that. Like
yeah.
that's really all he doesn't care. He
Yeah,
just
it's
wants
very
to
much
make
a
cool,
negotiating
good
tactic.
deal.
And then this is kind of skipping ahead to some of the notes I had elsewhere. But Cushman and Wakefield actually talks about this a lot. And they note that Trump tariffs the first time around were like 1% to 2%. So they're already kind of managing expectations there, at least in their account of tariffs. But I also think that that when you're talking about tariffs, you're talking about this like, yeah, it's a negotiating tactic. And the latest wrinkle is that the Washington Post has reported that these tariffs may be more narrow in scope than that 20% across the board tariff that we were so promised. Trump pushed back on Washington Post reporting, of course, because I will argue trying to get the specifics of these tariffs robs them of their power to terrify and delight. You get no tariff leverage.
Yeah, it's leverage. Yeah, exactly. It's leverage. Why would you want to?
And so I think that there is going to be some like twiddling of the tariff dials. I expect that for any one of these tariffs and for this entire package of tariffs, the feasibility is directly related to the negative impact on the economy, more probably the perceived negative impact on the economy. So if things are going bad and people are looking into tariffs, there will be pushback, and then maybe we'll ease off it. I looked back at like Trump tariff backlash on Google, and I for the first term I was like all articles written from 2016 to 2021 or whatever, and the backlash was from Republicans. It was Republicans coming in and saying, no, let's dial this back. They're now China's tariffing our Harleys, if you remember that, and so it.
Well,
I'm
the
not
farmers
sure.
too. China, went after corn and soybeans, and that's where Trump bailed out the farmers.
Yeah.
The political, the ideological flip flop, on either side.
We'll see
because
if
tariffs are
maybe,
protectionism, more of like a really more progressive liberal.
And we'll
policy.
see if Republicans come around to the topic of tariffs. But stranger things have happened ideologically.
I'm not a big fan of tariffs. I'd be more in favor of tariffs if they went along with eliminating the income tax.
Yeah. Well, and that's I think that's a big mess. But my point is, people are talking about this as a source of a great uncertainty, and I almost think that if it is a factor of the 10-year Treasury, then it's almost like more uncertainty than is needed, because you can't treat them as specifically correct words, as we all know with Donald Trump. Well, you have to look at the rhetorical meaning, and they're functioning as a negotiation tool.
Okay, so enough about politics and all of that. So multifamily market, where it's important, where the rubber meets the road, is the discount rate, the 10-year Treasury related to cap rates, and cap rates have been slightly declining since they peaked kind of earlier this year. They've been coming down, stable, coming down a little bit. People basically had called for the bottom in CRE apartment prices. But with rising Treasury yields, can that trend continue? Supply's coming down. We're seeing record apartment demand, according to RealPage, and what we're going to talk about. Investment sentiment is high. People, are bullish on the apartment and multifamily sector. And housing, especially rentals and multifamily, over the next 5 to 10 years. We'll get into what the Harvard says for the next decade after that. But for this decade, people are excited.
Yeah.
But if the 10-year Treasury is going up, it's hard to keep cap rates low. Cap rates at some point will expand because there is a normal spread between Treasury yields, 10-year Treasury, the risk-free rate, and the risk premium that one would like to earn on an unlevered yield or a cap rate on multifamily. So at some point, something's got to give. But what we're trying to figure out, why we're having this conversation, is this run up in Treasuries? Is it a blip pricing in all this rhetoric that is never actually going to happen? And we will see a return to sort of more normal interest rates. The 10-year Treasury coming back to 4% or below, settling at close to 3.5% is what kind of people think it might do. Or are we going to be in this 4.5 to 5-ish range? for a while, which means that cap rates probably need to be, an inch up, and there's truly going to be some more pain. And we talked to loan maturities that are coming up later this year in multifamily. That's really challenging because they can't get the prices to sell. And we have a lot of owners and borrowers that are going to be in a really tough spot.
Yeah. I think that's an important context. I think it makes it. I'm using it almost as like a symbol of the overall debt pressures in the CRE markets. Is this issue of loan maturities, because it's a nice key. You can kind of figure out the players and their motivations, and is it the CRE borrower that's got a loan that's going to be that has an interest rate that's going to go skyrocket. That's one angle. And then you've got the banks that are they going to give them a free pass this time versus that time. I think that loan maturities swelled in 2023, and we expected maybe that there would be, or some expected. We said that it'd just be a factor of the market, but there was also like some people speculating about how there would be a catastrophe because interest rates were high in 2023 and they were low 2 years before when those loans started. So was there drama? No. A lot of people got a free pass, I think, and now it's 2025. So.
The free pass was supposed to end this year.
Yeah,
that's the hard part.
I think it's.
Do they get another ride? Do they get another ticket to ride?
Well, and that's the thing. Is like I don't think the fact that it happened in 23 that doesn't make it not interesting today. I think that it's easy, probably sensible, to think there's a boy who cried wolf situation, but that avoids the really big questions that I keep thinking about is how much of a factor is CRE maturities in any given year, whether it's 23 or 25, and how much is this year different from any. This year special? Is this year special from 23 because this is when the brakes come on? I think it's special because it's been going on for so long.
It's compounding.
Yeah.
You're compounding the problem. And then the difference between just any other year in CRE is the difference between rates, where those loans originated and where rates are today. A lot of times there's maybe not that big of a spread, and maybe rates are even lower than when they originated and all is good. But now when they're higher, then you've got valuations that are different.
The same problems that you had in 23, stagnant rent growth, high interest rates, they're the same right now, and they're probably going to be very similar in 25. There's not a miracle in interest rates that, at least the way that we're depicting it, maybe there is, but there's not going to be a miracle in interest rates that's going to change the way that works. And I don't think that rent is going to really rocket forward. So we're going to see maybe a lot of capital calls, or I said, if you lurk on the comment section, and I don't lurk, I read.
Where are you lurking?
The comment section of Bigger Pockets, LinkedIn, or maybe the real estate investing subreddit. You may hear speculative stories about the impending failure of some syndicators and or the owner's capital calls needing to keep some CRE deals afloat. I don't think they're going to be catastrophe or widespread. In fact, you know what? I'll go out and say right now, I hope nobody fails ever. That's what I hope. That's not what I think. I think that realistically, if I were a bank and I gave a borrowers a break in 23, would I be more or less likely to give them a break now? I think they'd be less likely to give them a break now. I think that it invites comparison. The fact that it happened in 23 and 25, it's like, okay, then figure out, is it going to be better or worse? And I think that it's probably going to be a little worse for borrowers.
I think it's going to be worse. I think you're right. But can lenders, can they afford to wait? And will equity, can they afford to wait? Another 2 years, because I don't think patience is infinite for a lot of these groups. And they have investors, they have boards, they have mandates, and they also have to see they have to preserve principal and capital at some point. Yeah. And it's like, look, we gave you a shot, we gave you another shot, and like, look, just. Time's up. You've had 4 years, 2 years. You've had years to figure this out. Yeah, and we're still in this situation. And so here's the reality. Rubber's meeting the road, and you got to bring some cash to the table.
I'm not saying like XYZ is going to happen. I'm just saying like logically. This is how I'm thinking about it. The problems that were there didn't go away. You talked about cracks that weren't forming in the regular economy. I think the place where the cracks are these borrowers and the CRE, and the Fed noticed this and wrote a whole paper and said, all of these loan workouts, they're starting to have an actual effect in loss opportunity.
Do you think that they wrote that white paper with the idea, because it was written before the election, do you think that they wrote it with the idea that rates would be lower and then we would be in an environment where a lot of these workouts could take place and loans could mature and there wouldn't be that much pain. Almost it's like, hey, we're saying that it's safe. It's clear now, but now rates are up. And would they write the same paper again? Would they say, hey, look, you're going to have to incur some losses. Borrowers are going to get wiped out. You need to go ahead and do it. Or are they saying, okay, well, we'd rather not see that much pain because there may be some systemic risk across different banks.
I don't.
Why don't we extend a little bit? I'm just curious if their position has changed.
I think that their position is, well, the economy was in a shaky ground in 2023, and it's not in a shaky ground anymore. You can take the hit, and whether it's due to interest rates or whether it's due to just like the general economy is not in that dire straits. We're not talking about Silicon Valley Bank anymore, but. That was my takeaway, but I had.
If that's the case, would that lead to like another regional, banking crisis? If a lot of this, the good thing is a lot of the debt isn't as underwater as the equity. The equity is certainly underwater in many cases. Lenders, if they can recover, they should be they should be fine to be able to get most of their principal back. Some office loans, maybe not as fortunate, but at least multifamily, at least the debt is mostly fine. Now.
So I think that, again, it's like, I don't think that this is like the same. It's not the same as 2023, and it's super interesting to me just to think about what is going to be different and what's going to be a factor. And I think that it is still worth watching, just like any. And I said this last year, just like last week with Jay. Anyone's watching the loan maturities, and you're kind of looking at maybe if loans are coming due in your area. If you're an investor and you're looking to buy something, you're keeping an eye on it. Well, just still keep an eye on it because there's more to this story as it develops.
Well, that's 100% the case. There are owners and borrowers who are waiting to try to figure something out this year, and it's not getting any easier. So, all right, let's talk about this RealPage piece because we've been a little doomier and gloomier just talking about Treasury rates. But if you talk about the fundamentals of multifamily in terms of rental demand in the face of 4-decade high in new deliveries and supply, it makes one very bullish for multifamily, especially as new deliveries are starting to slow down materially right now, and we are starting to see a pickup in rental growth. Despite that it's typically a slower season, gets me a little bit excited for 25. Even though our projections at Great Capital are for 2.9% rent growth, a little bit below kind of average because we are going to still see new supply. But in terms of again demand, supply demand balance, rent growth, occupancies increasing a little bit, we might be entering a really nice sweet spot for operational performance.
I was surprised that it was this positive. The quote from Carl Whitaker is that the U.S. apartment market has responded to fears of oversupply with resounding appetite. Resounding, I think, is an apt word because I've been kind of tracking this. This is a trend. It's not just a data point because before and maybe in the previous quarter, we had demand maybe squeaking by supply or maybe just below it. Now it is quite like persuasively ahead of supply. Demand is persuasively ahead of supply. And earlier in the year, in like Q1, supply was way more than demand. So we have been tracking this and we have been noticing demand's catching up, and now it has fully caught up and overtaken supply, which is really good news. And it's not just a blip; it's the result of a very steady trend that has happened throughout the year.
Just for annually, as through Q4 2024, we delivered 588,883 units, but we absorbed 666,669. Which is. That's all. Now I rounded
up to 670K for religious reasons. All those sixes creep me out, Spencer.
I think it's all the years of Catholic school.
Yeah.
But one thing to note, and I don't know if you went back to earlier predictions of news of deliveries for this year. We had projections closer to 800,000, 900,000.
Yeah, I remember that.
Not all the way up to 1 million, but it was like pretty close.
Yeah.
And so in the RealPage, they were calling for not as many units to be delivered because it would be delays.
Yeah.
And there's been a lot of, and actually Carl Walter just did a post recently on LinkedIn about talking about how difficult it is to calculate and factor in delays.
Yeah.
Because, it's not like it's universal.
I remember doing this before and and talking to people about I was trying to talk to some data scientist friend of mine about what's the standard deviation here, because I was taking I was taking the numbers of permits, starts, and completions and trying to figure out, okay, if there was X number of starts in, let's say, 2018, what does that mean in 2020 or 2021 or whatever, and is there a way to figure out if you have all that information? And the roughest, you can't figure out for
I think
specifically.
I think you have to use some chaos theory level analysis,
especially because COVID has made this so weird. But in general, I came at
so many reasons.
2 years or 1.5 to 2 years to complete an apartment, but throw that out the window, and there's especially right now. I think that it'll probably get more predictable, but I was very surprised. I thought that there was going to be a little bit of a little bit less new apartments, specifically because I know that RealPage, the way that they calculate their deliveries is a little bit different, but they're not trying to. They're not trying to include everything. They're not including single family rentals, I don't think, in their completion. So that is a big number.
Yeah. But this chart, just seeing how supply was just outstripping demand really through all of 2022, really 2022 through 2024.
Yeah.
And we just basically halfway through 2024 started to break out through that, and we're seeing even again, as we're peaking, supply is peaking, the demand is really outpacing, and it's wild. To see,
and there's
the correlation.
Yeah, and there's that,
and they will come.
Yeah, and that's a really good point. They have came in, and I'm surprised that so many have come so quickly. And you can see the progression. I guess it was a little bit under in the third quarter of 2024, but it has steadily risen.
And so what will be interesting is, does this level of demand? Is this related to building and they will come, or is it because of the unaffordability of buying a new home and some household formation? Yeah. And when that new supply falls off, as it will, closer to the end of 2025 and 2026, do we see demand remain elevated?
Yeah.
And if so, we would expect to see, especially if we're seeing some overall moderate inflation in the economy, one would expect to see robust rent growth.
Yeah.
And occupancies increase substantially.
Yeah, I think, well, and this does lead into this Harvard Joint Center for Housing Studies article, but I keep thinking of there's a short-term housing demand, high housing demand, short-term housing unaffordability. And then if you look long-term, after a certain point, there is this, does seem like, is it a tipping point or whatever? Are a bunch of baby boomers going to give their kids houses, and now there's going to be a huge glut of houses? Are we going to overbuild because we're trying to address unaffordability? And now, oh no, we have too many apartments because all the baby boomers are gone, and now we've got not a lot of alphas.
You're suggesting a demographic cliff, essentially.
Yeah.
That over in not 5 years, call it 15, call it 12 to 20 years from now, the baby boomers are going to be going into assisted, whatever they're going to be doing. Not some of them not with us, some of them still with us. But moving out of their homes. Yeah. And because I met with the City of Carmel, Mayor of Carmel, a couple months ago, and it's a big issue, top of mind for housing. It's a pretty affluent suburb, but their big issue is we've got all of these baby boomers living in these 4-bedroom houses, but there's only one or two of them. They need to unlock all this housing supply, and in their mind, we need to build stuff that they can go in to live in now. They don't want to go to an assisted living facility.
And they are not going to vote. Those baby boomers that are living in their houses are not voting for apartments. That's their.
Oh, that was the other man. That was the other, and that was I had to have a conversation with them. Is basically Carmel has basically voted, or has spoken. They're like, we no more of these apartments. They can build them somewhere else, but we don't want any more apartments around here.
I spoke with someone that was in Carmel, kind of was running for Congress, and he did well. And he said, yeah, it is a bunch of these older people that their number one issue is, I don't want that apartment coming in next door.
And a lot of it's just a reaction to change that's happened over the last decade. A lot of apartments have been built, and they're looking around. They're like, I don't want any more of these. Yeah, it's the roads.
Well, and you can sympathize with that if you had a nice view, and now you're looking at that apartment, and now you're thinking, oh man, the traffic, and there's a lot of assumptions that people have with the apartments coming up that never pan out quite as negative as people think. But yeah, you're right, it's change, and that's tough to deal with. I think that being in this business has let me, I have to swallow some hard truths. And the first hard truth is, if that ever happens to me, I can't complain. I'm not allowed to complain. If the apartment comes in next door, I will hold my tongue, and I will chastise myself for even feeling bad. But the second is realizing, no, that is a valid concern for people that don't want it. You have to work in through proper channels. But that second part, man, that's where I get really frustrated, because the needs, the housing, the kind of abstract housing needs are greater than the specific need of someone that doesn't want to see apartments in their backyard.
It's so different.
Yeah.
But potentially, so let's go into this Harvard Joint Center for Housing Studies piece, because it's a little less bullish. But we're not really talking like this cycle. We're really talking many years out, and so and they're making some assumptions here and projections.
It's funny that
a lot of it is replacement rate. A lot of it is related to immigration.
I don't even think about. I didn't even really think that much about immigration. I kind of acknowledged it, especially because Harvard had an article last year that was almost downplaying immigration's role in driving up housing costs. It was an implicit rebuttal to a John Burns Research and Consulting piece that said, hey, immigration went up, and also housing went up during these points in the pandemic, and Harvard went back. They didn't clap back, but they released data that was like, hey, just in case people are thinking this, actually housing prices went up before immigration went up. So there's not a perfect correlation between immigration and housing prices, but they are saying in this piece that there is a correlation between housing demand and immigration. So it's strange for me. I think they're having it both ways a little bit, but
I think you're having it both ways.
Yeah. But my point is,
I don't see how. I mean, I think that it's like most things, like all things. There's some nuance.
Yeah,
it's not the end all be all. Mm-hmm. It's not like there's a talking point of saying, basically, immigration is the reason for housing prices that have gone up. Mm-hmm. It's not the reason, but it is a reason. It is a factor. It is a variable. The question is not if, but just how much and to what degree.
Yeah.
And I think Harvard, just stereotyping a little bit, they typically are showing up on the left end of the spectrum in terms of housing, and often providing a counterpoint. And I think that, again, I'm speculating here. Mm-hmm. But they saw a narrative in the housing market related to immigration, and they probably didn't like the anti-immigration rhetoric, and they wanted to put a piece out to somewhat counter it and to subdue it. And they're basically saying, look, it's not that extreme. It's more nuanced. It's not just because there's been immigration that's been driving housing costs, but they probably went maybe a little too far and to downplay that it's a factor at all. So it's somewhere in the middle. But there's been a lot of studies. I mean, I remember almost a decade ago reading a report from, I don't think it was Harvard Center for it doesn't matter, but essentially laying out that the difference between positive population growth in the United States and flat or negative is immigration.
That is my takeaway here. And
that's a big picture.
Yeah. I'm not disputing immigration as a very relevant and important aspect of population growth, household growth, housing demand in general. I'm just saying that population growth is at a point right now where immigration is a bigger factor. The fact that a little swing in immigration can have this big swing in the housing demand of the United States, it means that we're in this sensitive point. So I think that this overall takeaway is actually a little similar to some of the projections we covered on the Gray Report years ago. There was a Cushman and Wakefield, this was early days of the Gray Report, talking about like 20, 25 years hence and where this is like a demographic cliff. And I don't think that it is a bad thing to be building more housing now. If we end up with
we obviously need it.
Yeah, we need it. If we end up with much more housing or a lot more housing than we need, then the affordability crisis is
the word
solved.
well that's the thing. So from our talking our book, like we're investing in housing, we're investing in apartments. The best thing for us would for no one to build any more housing ever again, because you have limited supply and the prices of it all go up and the rents go up. That's not what we want, though. We want a balanced market. We want some, steady growth over time, finding areas that need more investment into housing, invest in those markets, take advantage of the inefficiencies. But it would be if we built way too much housing, which we're proponents of. Let's build a lot more housing. We need to build more housing. We're investing into housing. That would lower the price of housing.
Yeah. And so that's kind of
bad for us, good for everyone.
My rejoinder to that, to the kind of fears of that, is I'm guessing that developers will react to this. There will be a dial back in apartment construction as a result of this lower demand. That is a problem that can be solved. I still think it is. There is going to be an interesting moment coming up in the next 10 to 15 years where we may be at a turning point between unaffordability and affordability, between over and under supply.
But it's also, we're looking at, population and population growth of an entire country versus different areas. It's all, we'll say
very good
local,
point.
Local. So you might have, negative population. Let's say we have a declining population in the United States, which we're basically kind of flat right now, barely positive. There will still be markets that are growing. There will be more markets that are declining. But let's look at a market like New York City, for example. New York City is a declining market, declining population growth. They're adding tons of new inventory.
Yeah.
There are still opportunities. I'm not investing in New York for a variety of reasons, but certain areas of New York, people are leaving. Other places people are moving into. Same thing with California. People are still building new apartments in California, even though I don't know.
And the other thing that I would say too is there is, and I don't know how much of it is not real or not, but houses depreciate. There's a cost to maintain that house before it falls down and collapses in and on itself, and same thing with apartments. So that cost has to be factored in. It's not like you build a house or it's not like the baby boomers give you the keys and that house is perfect. Maybe some of these houses aren't doing so well, so you're going to have to build one anyways. There's a little bit that may not be perfect, but that's just another
Here's another factor where what this piece doesn't get into is, declining growth rates, demographics is also lead to lower interest rates, lower inflation. And so while, and look at a place like, other developed countries, Germany, Japan, Switzerland, places like that, the UK, not exactly, centers for growth, but, their cap rates, their interest rates are way lower than they are here in the US, and their cap rates are way lower than they are here in the US.
So another kind of comforting thing that I have is this is far enough into the future where there is some uncertainty. It's not a set thing that, oh man, we need more people. Things are going to go, so much poorly because, it's not just it's not one administration that's going to be able to determine immigration. And if you scroll down, actually, you can see the immigration estimates here. So from the period, I guess, from 2021 to now, immigration was actually a little bit lower in terms of raw numbers than it was between 2021 and 2011. In other words, during the Bush administration, immigration was higher, according to these numbers.
No, Obama deported way more people than Trump did, or George W. Bush did.
Yeah. And so
it was much tighter on immigration.
Despite the fact and according to these lines, actually, there was a very dramatic increase in immigration. And so I'm kind of cheating by saying it's the average, but the average between 2021 and now is lower than it was in the first part of 2000s. And I say that too, and I say raw numbers because the population has been increasing in that time. And so, percentage wise, we may be a little bit lower in immigration. My kind of point is that these things change. It's hard to predict,
Something to watch.
And something to
Something
watch.
to be aware of.
Watch it along with those tariffs. And also remember, like, the exciting words are maybe a little bit different than the boring reality. But who knows? Maybe everything's going to be exciting. And wow, that'd be a great gray report. I can't wait to report on it.
Well, and then 10 years from now, he's like, all right, we're here. Where are we at?
Yeah.
So, a lot will happen in 10 years.
Yeah.
What do we?
Cushman & Wakefield.
Cushman & Wakefield. I thought we did that.
We reviewed it a little bit. I just want to touch on one more thing
Okay.
in the Cushman & Wakefield.
Okay.
We talked about tariffs. We talked about loan maturities. But I want to skip to apartments because there are other reports that we're talking about that talk about the kind of broad scale stuff. But their commentary on Sunbelt demand and supply very much jives with what you were saying. It's 0.9 of 10, so they kind of save the best for last, I think. But they're basically saying, like, there's a lot of building that went in the Sunbelt, and it's regional. It says with new construction slowing, multifamily fundamentals are poised to strengthen going into 2025. Multifamily completions are expected to drop by more than a third, by 36% next year. But overall vacancy levels will also improve as well. So we're going to get multifamily completions going down. Demand is bouncing back quickly, as they say, and it's a pretty good picture right now. I think that the Sunbelt demand and supply, though, is going to be is really relevant as a way of. It could push the averages in a different place than you might think. You look at the demand. Actually, if you scroll down there, it has the Midwest, Northeast, South, and West. And you look at the South. That is where the majority of the demand is coming right now. It's a majority of supply. So, I think that Sunbelt could bounce back quicker than we thought. I've been reading things recently about how much job growth and how much population growth is in there. So it'll be interesting to see, and good for them, if demand punches through all the huge flood of supply.
Yeah. Yep. All good points.
Yep.
All right. Now let's pop on over to Moody's.
All right. Oh, you're skipping MSCI. That's fine.
Or did we already do MSCI?
No. MSCI is this one was actually the most interesting for me because it is it's a perspective that I don't get a whole lot. I'm stuck in the in blinkered eyes, multifamily or commercial real estate investment, and this is talking a little bit more of a bird's eye view, talking about private equity, talking about stocks, talking in more general terms about the factors and the levers that are pulling and pushing the investment economy. I like this line because it has a school paper feel to it. It says, for half a century, investors have analyzed stock markets through regional, sectoral, and factor-based frameworks. It's like, okay. That's what I would say. You don't need to say that. I get it. So we fly over the stock market where momentum seems to be a big thing. They're talking about how buying the recent winners really carried the day, carried a lot of those gains in 2024. And recent winners in this context is tech stocks. Then after that, they talk about regional differences here. And they're talking about, they say economic divergence, which is among different global regions. I think it rhymes maybe with the regional differences in the multifamily market, but it is not true because the regional difference in U.S. apartment markets due to specific patterns of construction.
Are you saying that the Midwest is carrying the whole world?
No, yeah. That's what I'm saying. Exactly right. All right. As MSCI writes, the global divergence is due to tepid growth and related challenges such as political uncertainty in Germany and France and deflationary pressures in China on the back of its weak property sector that is contrasting with really kind of like a rallying stock market in the U.S. And these circumstances, as well as different expectations for rate cuts, which are showing right here, are a large part of these. Now, to go on these rate cuts, I see them also, yes, they're high in there. They're a big headache. But they're also a statement of the strength of the economy. If rates are high enough that we think things can handle it, that's why the projections are a little bit higher because they think that things are going to run hotter. And compared to the Eurozone and especially Japan, they're kind of doing middlingly well. And so if you see this as an expression of economic strength, well, yeah, it's true, because Eurozone is not doing as well as U.S. Japan's not doing as well as U.S. I think it's more complicated than that, but that's what one of the points the MSCI is making here is, there's some economic divergence here. Part of the equation are these interest rate expectations, and the really looks like by the end of 2025, we're going to be at the peak of the Eurozone interest rates, but it will still be well off our peak.
Yeah.
That being said, it looks like a whole 100 basis points difference between where we thought interest rates were going to be and where in 2024 and where we think that they're going to be now. That's what we talked about at the start of the show, is how much higher for longer is really higher for longer. And that plays into loan maturities, that plays into sales volumes, that plays into a lot that's happening in the multifamily market that is not worth missing. Again, like, watch this space. You skipped it to real estate. I think that that's the other part that I thought was super interesting, because I don't really think about it in this way, and the way that they have it here is they're comparing for sale price or listed for sale price. And now this is why it's interesting, because I don't know if I'm wrapping my head around this correctly or not. Looks like what they're comparing here is the listed price of assets that go for sale, so I bought it at this value, versus the average price of an asset that is not for sale or anything. This is just what it's worth. The part of me that doesn't understand is like, I don't know what it's worth until I sell it. So I don't know where they're getting the asset value growth is, but the general idea is people are buying things at higher prices because they think the price is going to go up, and they're doing that a lot now, and
a lot of transactions. Yeah. Well, sorry, fewer transactions, lower volume, decent price movement on lower volume in the U.S.
Yeah, and that was my other point too. So yes,
which makes sense. We haven't seen that many transactions, but cap rates have come down slightly, not because there's been a ton of sales activity, just because the few deals that have traded, there's been a buyer at a decent price.
And that was my other thought too. Is like this is less persuasive to me. So list price went up when there was a bunch of transactions in like 2021 and 2022. Those correlated. There was a lot of people buying and selling for high prices.
Now they're trying. Yeah, they're trying to.
Yeah.
They're attempting to. I mean, we see deals all the time, still do, where it's like, no, you're not getting that, especially as the 10-year where it is today.
And now there is lower, and there's a jump in. Now there's like lower demand, and the jump in listed price makes me think that, like, I don't trust it as much. If there was a bunch of people buying at that price, I'd trust it, but less.
But the transaction volumes are increasing.
That's true.
If you look at that, that period is ramping up, just getting ready to go positive.
It's a really good point. And this, I think, it's also kind of the point of MSCI too, is this a leading indicator? So they said that, and you can see on the chart, the listed price popped up like about a year before the asset value prices pop up. And we're seeing list price pop up now. And does that mean that the asset values are going to pop up? And are people correctly predicting, continued performance in CRE assets?
I think people are, maybe outside of office universally, but I think there's a lot of pent up demand, and in the
current interest rate environment, have that pop is persuasive.
Yeah, and that's despite the interest rate capital markets pressure. Yeah, but again, it's just like super simple, rudimentary. Just technical analysis. I mean, you just look at the wave shapes. Yeah. Like, do we see the wave the period right here? How it's moving up now? Can it reverse? Like, yeah, absolutely. But universe usually works in a lot of cycles.
Yeah, and so. It does seem like there is a shift, and you talked about this at the start of the show. Is are higher interest rates really going to put a damper on transactions, or is it really going to move cap rates? That could be true, but I think that investor sentiment, there are people that are really, really wanting to transact in there.
Yeah, there's a lot of dry powder,
And,
the stock market's shaky. PEs are high, and people are rebalancing right now. And folks are saying, "Hey, I saw Scott Trench, CEO of Bigger Pockets, over this last week. He typically does like an overview of what he thinks is going to happen this year, and he basically said he sold half of his index fund portfolio and is re-looking at real estate opportunities when he was basically out of the real estate market for a period of time, just thinking that things were going to get. He basically, I think we covered it actually last year on the Gray Report of how he basically reposted.
Oh yeah. I remember that
2023. Basically, it's going to be tough. Well, he's finally wrote a new outlook instead of just repeating the same thing. Basically, it was like, no, now I'm getting back into real estate. I'm selling half my stocks, going into real estate right now, because I think that we are going to see that cycle, that shift of where stocks were the winning, Bitcoin, but outside of crypto, stock market performed exceedingly well, and now it's real estate's turn.
Yeah, the crowd is moving, it seems like, towards real estate a little bit, and that's just sentiment. And I think that there's reasons also to believe in like the fundamentals, especially multifamily. So there's good support and like a good structure behind that. It's not just like following the crowd.
Yeah. Well, it's getting me excited, Matt. I don't know if this is a good time to mention this or not, but we're working on a new deal here at Great Capital.
So that's what I heard.
It's too early to announce a lot of specifics. It will be an offering for accredited investors only. This isn't an offer to invest, but we found a really exciting, really newer property, kind of 2020s vintage at a deep discount in a growing market, suburban market, outside of one of the top rent growth MSAs in the Midwest. It's in Indiana. We're really excited about it. The first deal we're going to do in 2025. We should be under contract very shortly. It's going to be the smallest equity raise that we've done in the last year or so. So I think it's going to go quick. And so if you're an existing investor, get in touch with myself, Blake, Griffin, investor relations team. If not, you can join our investor portal so you can get access to the deal as soon as we post it. You can do that at greatcapitalllc.com and sign up. But
you'll hear from us with more details as soon as we can share. The minute we can share, we'll be.
But it's exciting because and honestly, like this deal, there's not a major value add component, and we're not trying to speculate too much. We're getting an incredible piece of real estate at a really good price with really good growth prospects, and we just have the ability, since we're local, to operate it a little more efficiently. But it's an exciting time to be making acquisitions in the multifamily space. It's an loan assumption, so the treasuries would, if we were taking out new debt, it would be more of a challenge because it'd be much more volatile. But we're assuming a fixed rate loan, so we know exactly what we're dealing with going into it, and it essentially removes interest rate risk throughout the term. And we've got about like 6 years of term left on it. So I'm excited.
Yeah, it's hard to think about a single acquisition, kind of characterizing how you think the market will go, but it certainly does we're hitting the ground running. It makes me a little bit more optimistic for 2024 that this deal is out there, and there were other deals too. I've been following. I talk in the office. there are other deals out there, and there are deals that that we think about that people are buying and selling, and it just seems like things are picking up especially more compared to last year.
Things are picking up. People are making purchases, and surprising, the prices that sellers want to sell for is relatively high, and there's not as many buyers. But the buyers that are out there are pretty aggressive. We were not the top bid on this deal, actually. There were bids that were higher than us. We were just the buyer with, I think, the best track record. That's a track record in the market ish of closing. And we've just closed a bunch of deals. We've just done a loan assumption. But there's definitely competition out there. Yeah. But in this example, the seller wanted to get significantly more than what they were able to actually get for it.
Yeah, yeah.
So like they were able to get, arguably like I think they're selling it for a good price. Certainly couldn't sell it for any more. We're getting it, I think, at a great price. But it is about $3.5-4 million less than they really were hoping to get for it.
Yeah, yeah.
So it's a pretty nice.
Well, and
discount.
that's kind of my point is like there may be more sellers that are motivated there, and we've talked about this before. It's motivating for a seller to think that, well, the market's good enough, I can go out and buy another one now. It just as much as if they were motivated by something like I need to sell.
So here's another real time anecdote specifically. I mean, I've told them, look, the price isn't going up. Treasuries are increasing. The price isn't going up right now.
Yeah,
like maybe in couple months, 10-year turns the other way, sure. Talk, get some more rent growth, sure, but you're selling it right now.
Yeah.
And Treasury is trending one way, and it's not in your favor. You have a couple months to a year timeline. You're trying to sell it. I've got a 5 to 10 year timeline. I can wait.
Yeah.
I can wait for the Treasury. I don't care if the Treasury moves up a little bit and then it cycles back down, because if the 10-year Treasury is moving up a little bit, that means there's probably a little bit more inflation in the market. That means there's some more rent growth in the market. And again, I don't really care as much about capital markets for years after I bought the property, assuming that expense inflation doesn't get too out of hand. So again, time's working on our side versus working against us, and the need for to have a certainty of close. Even though we weren't the highest bidder, saying, look, you want to transact now, because if you go with somebody else, I told them this, I said, we're the best buyer. If you go with somebody else, you're going to negotiate a PSA, and 6 weeks from now, they're going to bust out of the deal because they either can't raise the money or something happened. They're going to get spooked. They're going to bust out of the deal, and you're going to be in a worse position, have less leverage. Treasury's going to be higher. You're not going to be able to find a buyer. We're the best buyer. Select us. We will close this deal. Because we've got a long-term vision.
It's interesting. There's still risk in the market, especially at some of the prices that people are looking for, and weighing that between like the certainty of. I think there'll be some interesting opportunities that come up, especially in this. Yeah, the pressure of high interest rates makes this. I said this last week. I think that interest rates is a source of greater uncertainty for me than tariffs. So,
but it's just the tariffs are influencing the interest rates
potentially,
or the threat of tariffs, the idea, the concept. All right, Matt.
Concept of an idea.
Concept. Yeah, we got concepts of a plan. All right. Well, if you'd like to learn more about this upcoming opportunity, if you're an accredited investor, hop on over to greatcapitalllc.com. We're starting to have conversations with existing investors. But again, go to greatcapitalllc.com. There's a button to get access to our investment portal. That's where we have our deal room, where you can access due diligence documents. We're as transparent as they come. We basically throw out all the materials that we see that isn't like super confidential, proprietary, as in like the sellers telling us we can't share it with somebody. We just throw it all at you, let you take a look at it, ask questions. But we're going to be posting our deal preview videos. We're going to be having our webinars. We're going to have obviously our decks, all of our videos, all the stuff that we do for all of our deals. It's going to be available very soon, but you want to make sure, again, go on over to greatcapitalllc.com, sign up for the portal. If you have not already, if you do have access, hop in the portal, check it out, express your interest, schedule a meeting with the team. And I'm excited for this deal. It's going to be a good one.
Oh, yeah.
So, all right. Make sure you subscribe to the Great Capital YouTube channel to keep getting these updates. We'll see you on the next episode. Thank you.